Good afternoon, everyone, and welcome back. And today we're going to run through our financial and economic update. So, as always, join with Kenneth Banland. Welcome.
Thanks for having me.
Firstly, apologies. We did have to delay this 1 week. Kenneth was a bit crook, so good news is he's back on board today. So, for best wishes for all those who are sick out there, and wish you a speedy recovery. Today we're just going to run through a normal process. So we're going to go through the reporting season. It acts as a lens for outlooks. So we'd like to run through that. We're going to go through some sector trends. Inflation's a big issue at the moment. So you would have heard that talked about a lot. So we're going to cover off on what that means for our market, our economy. We'll go through those economies, the Australian economy, and then look at the global economy. And then we'll tie that back into our investment strategy and hopefully where we position our portfolios from here.
That's the plan.
All right. Well, on that, mate, I'll hand it over.
General disclaimer, please don't take this as personal advice. Anything that we say is general in nature. So really to kick things off, what we want to show you is how reporting season went. And so we've sort of broken this up into two parts. One, how FY22 went. It was actually a pretty reasonable outcome.
Yep.
If you think about all the different sort of obstacles that companies and corporates have had to face, labour shortages going on, cost inflation, you've got supply chain issues. I actually think it was a really, really positive result. And how we benchmark that, you look at the top line, it was a slight earnings per share beat. That means that where the market was expecting earnings to come through on an aggregate level, it was slightly better than expected. The other area that I thought was reasonable when we break this up and look backwards, so FY22, was the dividends that came out. It was another successful dividend season. But then when we look forward, and that's where we start to see maybe some potential for a little bit of concern. We noticed that, and I'll touch on this on the next slide, but there may be a downgrade cycle starting to come. We saw some earnings revisions changed. And on this graph, the thing that stood out to me, and we couple these together, was the top 50 companies on our market, biggest, most mature. They actually had the biggest miss against analyst expectations that we have access to going back to 2016. And then you couple that with, well, what happened? When a company misses, what was the price action? And it was actually really benign. So it was either the market thought that was going to occur, or they just took it in their stride and think that there may be some greener shoots moving forward. But the one thing that we will note is on a lot of those companies, just to watch those inventory levels. When we look at 3-year averages, the inventory levels that we've got going into this Christmas season is actually far higher than what we typically would. And so if the consumer does start to feel a little bit of pressure, and it's not as good as what companies are expecting, you may see some pretty significant discounts and earnings downgrades in.
So one of the key things there, so whilst we've seen through the reporting season the resilience in our earnings, and we've seen that volatility in our market and some values come back, it doesn't necessarily reflect that they're of good value if the earnings come or that profile comes off.
Correct. So yes, we focused on the has been, the past. This is all about the future. And remember that the market is forward looking. When we look through this on every single sector that is on our market, so financials all the way through to utilities, there's the area that I would like to focus on here is that FY23 earnings per share revision. And you'll notice that across all of them that there has been some downgrades to earnings. And I should say that this is from Macquarie Research, so it's not a consensus piece. But I think it is concerning that when you look forward and there are starting to these expectations are starting to erode, what we don't want to see is that perpetuate. The other side to this I found also really interesting is so cash flow. What's happening in corporate's cash flow? So we've got operating cash flow and free cash flow. Operating's self-explanatory. Free cash flow is just cash flow that's available to equity and bond holders. So free cash flow to the firm. There was actually on both sides, you can see that there's more reduction in terms of cash flow in operating and free cash flow. Another slightly concerning statistic. And then in the middle there's CapEx, so capital expenditures. You could look at that both two ways, really. You could think that corporates are going out and have really big, robust plans for their CapEx.
Yep.
So they're going out and doing new projects. We would take the other lens and say that this may be the same amount of traditional CapEx, but just at a higher cost. And so when you're thinking around, is a company having to spend more just to do the same?
Yeah. As a result of inflation.
Correct.
Yep.
Now, valuations for this particular one, this is again forward-looking price to earnings levels. Now we've stripped out, we think it's appropriate to strip out commodities at present. So you're only looking at the industrials complex in Australia here. I mean, at first glance, it doesn't look that bad. It looks like we've reduced down from very, very high levels. But I think you've got to put this into context. And when you think around where interest rates are at present, what's the projection to be for those interest rates? Yep. We actually think this might start to come down a little towards really that more historical 14 to 12 times. And you can see that that's roughly where the apologies.
Surviving from that sickness.
Yes, still got the cough.
So if we do see this comes back to that area before where if we see that earnings deteriorate, then we'll see those valuations that you're saying around long-term averages around 12 to 14, is that correct?
That's right. So I know this is a long-term graph and there's a lot going on, but we think that in a higher inflationary environment, you're going to see those interest rates come up, and there's potential for that earnings to start to decline. So it's just something to look at maybe a little deeper than what we would traditionally look at with the valuations. So I don't think you could do an economic update without talking about inflation. It's everywhere at present. So what we thought today would be a really good thing to do is to maybe explain how we got here. Yep. And so there's a form of economics. It's widely used called Keynesian economics. Basically, if you think about it, the government and central banks are supposed to help in bad times and pull back in good times. Yep. And so they're the lever. Before all this started, by the way, when we've been doing this for years now, we were, before the last year, we were always talking around, well, we need inflation. We're almost in those deflationary circumstances. Yep. Well, that's about faced. And the reason why it's about faced is because of the huge stimulus that was provided through COVID. I don't think there's a better graph, for example, that I can point to than what's on screen at present. So McKinsey, the consulting group, did this. Those little black round circles, that's the amount of economic stimulus that got pumped into the global economy, or not to the global economy, to the respective countries that are on that graph through the GFC. Yep. And that was at that time the most amount of stimulus that was ever provided through the whole to the world. Yep. You can see those massive blue circles. That's what got pumped in through COVID. And it's really Keynesian economics on steroids. And so what happened? Well, people couldn't go out and travel. So they started to pay down some of their mortgages. The mortgage rates dropped. You've got high savings rates. And then you started to see, well, if I can't go anywhere, I may as well start to purchase things. So we saw discretionary expenditure skyrocket. And then we also saw asset price inflation. And so, as we've put there, it worked a little too well. And to be fair to central banks and governments, this is what you're supposed to do. So there's no reason to be angry or critical of that. And again, when you point back to those last 10 years, very, very difficult to find any sort of inflation. So they were prepared to overshoot inflation to try and help with these unemployment and what was happening in the world. So if we fast forward to now, well, we've certainly got inflation, and it looks to be like it's sticking around. So it's sticky. It's not something that just gets peeled back really, really quickly. That graph to the right, you can see that really over the past 20 years, we haven't had to deal with a macroeconomic backdrop like this. It's a very unusual time. And our expectation is that, yes, we've had this huge build-up, inflation's been around, but it is hard to try and stop that spiraling out of control. That's why we've got these interest rate rises. And while, when we think, oh, next year it will all be okay, well, it might be, but that might just mean that inflation drops from 8.5 or 7.5, wherever we eventually get to 4 or 5. And I think that's something that the market will have to deal with, and consumers will have to deal with, because if it does stick around, it's going to be longer interest rates for a longer period of time. And you can see in a later section, we've got where banks are actually expecting that to be.
So with that there, central banks using that monetary policy to increase interest rates to control inflation, usually between that 2 and 3% is our target here. What about when some comments around some of the stuff we see in the marketplace is going, yeah, that's great. And you talk about central banks, even some commentary around front loading some of those interest rates. So we've seen some bigger licks of increases there. Yep. Maybe some context around some of the issues that, when an outsider looks in and go, well, yeah, but some of this is not just wage increases. It's Ukraine war, energy,
non-core inflation,
things that supply restraints, things that we can't control. Any comments around how I think maybe dealt with?
So it's a really great question. And do I think that the blunt tool of monetary policy should be used to act on non-core inflation? Well, I don't, but there is an argument there then. Well, if you raise interest rates from 4 to 10%, you're going to stop someone driving to Sydney. So you can make that comment that yes, they can. I think the best situation to gauge this on is Europe. Yep. So Europe, they're going to have really, really aggressive inflation moving into the European winter. And what that's going to do for their economy is, well, the European Central Bank's going to continue to raise rates. They don't want this to catch into a contagion of wage pressures. But what you're seeing is some unconventional monetary policy tools. So yes, they're going to start raising interest rates, but Italy, Greece, any of those southern countries, they can't really handle higher interest rates at present. So it's called an anti-fragmentation tool, never been before used. I feel like it's a little bit of a hand pulling a lever and then pulling back at the same time. But what they're trying to do is control interest rates in some of those southern countries so we don't have the European debt crisis. And then on the same hand, try and continue to stamp out the wage price, embedded wage price spirals. So the Australian economy, I think it's pretty safe to say that over the last 12 months, it's been in excellent shape. There's not a time that we've been able to say since the 1970s that we've had a higher participation rate and also the lowest unemployment rate. We're in the 3s. So the labour market is so tight. That should lead is leading and continue to lead to higher wages. And what I thought was a really, really great graph by Yarra Capital was where we are in a cycle. And I think that when you think around our economy right now, you can kind of make the case that we're up around that upper right-hand section where demand is really starting to peak. We've had the unemployment rate has fallen through the roof. Wages are starting to rise, but what's starting to occur is those interest rate cycles are eating to real wages, so purchasing power is starting to fall. And I think potentially, though it hasn't shown up in retail sales yet, we may be starting to see the peak, at least, in terms of a slowdown in sales. Now, what you wouldn't typically see is a white-hot Australian economy and consumer confidence where it's at now. And so it's at almost GFC lows. People don't feel very optimistic. Why is that? Well, again, wages are starting to go up, but your cost of living is going at a higher rate than that. They're now starting to see their asset prices start to peel off, and so that wealth effect that we loved through the back end of 20 and 2021 is starting to peel back. And so it's almost like the consumers are forward looking, but the data that we're seeing on the Australian economy is in the past. I find this really interesting, and I won't spend too long on this page at all. This was taken directly from our April 2022 market update. All I want you to look at, apart from, we will send these around as well, but apart from the words on the slide, that graph there shows where our interest rates were on the left-hand side and where they're expected to be in December 22. So you're looking at in April, we were looking at 5 interest rate rises at a peak level of 1.25%. Now, if we go to the next slide, this is where we're at now. Taken in July, sorry, but we're looking at a terminal rate for this calendar year above 3. You can see that we're beneath 1%. We're at 0.15% in April. We're now at 2.35%, but the speed and aggression that has the RBA and all central banks around the world have acted on has been really almost identical to the 1994 situation. And so it's very, very aggressive. Yes, we haven't really seen the effects flow through in terms of inflation yet, in terms of the unemployment rates yet, or in terms of what's happening with corporates. We think it's going to take some time, but it will start to bite into FY23. And just a simple about face from the RBA. We've taken this from the Statement of Monetary Policy in their September 22, and I will just read it. Inflation is high globally and has risen further in recent months. The rapid increase in the cost of living is reducing real incomes. So they are aware of it. But I think, it's not just them. We look at the World Bank. They're making the same comments. The Federal Reserve is also on a warpath around inflation as well. So really interesting times. To your point, there has been some front loading that you spoke about, more aggressive interest rates early to try and stamp out persistent sticky inflation. When we talk around this, what does this mean for home borrowers? I think we're getting a lot of questions on this as well.
Yeah. Yep.
And so,
That's okay.
Yep. This is from CBA. They have the largest residential home loan book in Australia by far and away. Again, I know it's not forward-looking, but I thought it was really interesting that right now we've got lower home loan arrears and lower troublesome or impaired loans and assets than we did in 2019, according to their book. And on top of that, if you want to talk about capital stability in banks, how much provisioning have they put aside for what may be about to come? CBA is in a fantastic shape.
Just while we're on the banks, if I may, big talk around, with these interest rate increases when they're biting in. Fixed rate loans have got an impact on that at the moment, and there's a fair whack coming off maturity in a few months. Any comments around that?
Yeah, really, it's a different situation for Australia because normally we're almost all in variable. We're not like the US. They typically take 30-year fixed rate mortgages. And so when we talk around the RBA's ability to affect the consumer with interest rates, it's normally that we need to set a lower terminal rate than the US. we actually think that it was a great period of time when people took advantage of ultra low interest rates and fixed their loans, that the same effect is not being felt by the RBA, by the consumer with the RBA cash rates at present. There is talk of an interest rate cliff when the bulk of these start to roll off next year.
Yep.
And so I think that'll be a really interesting time. But at present, it's affecting the tool that the RBA uses, which is just interest rates at present, to slow down the consumer.
Yep. And is there a market view as to whether the Reserve Bank will actually wait until some of that impacts? Continue an increase in rates and then see what happens for the impact of that.
So I'll just talk about market expectations at present. So market expectations for this year will be that there'll be another 50 basis points towards now in December. Where they do that, no, it doesn't really matter, but that's where we'll end up. Terminal rates for next year sit at about 3.5 to 3.8%. And the expectation is that over those next few months, when we start calendar year 23, I was about to say FY 23, sorry, is when the RBA may take a pause. So we might see no interest rate rises for January, February, and then maybe they start in March or April. So how does this all end? Well, we're starting to see the leveraged property market start to peel off. I think that there's probably doomsdayers out there in the present at present that can jump on this. I think there's replacement costs that people need to be aware of, and there's certainly vacancy shortages. But you can't escape that prices are falling. It's just where they go,
and what pockets they're falling in.
Exactly. So we're not ultra property bears. And I think there's a couple of reasons that we've tried to point to here. One, servicer billing has actually been really strong in terms of the consumer. Yes, that will certainly peel back as interest rates go up. And then on top of that, the job market is just unbelievably strong. And so while there definitely is talk around some global recessions in terms of Europe and potentially America, we think it's exceptionally low for Australia. So to start things off, what we thought we'd have a look at is just the US dollar. And because it's making a lot of headlines at present, it's at a 20-odd year high. Now, why is that important? We think there's a few reasons. One, clearly the US economy has done well. They've got interest rates moving up, all the right things. But people tend to flock to the US dollar in times of crisis. And so there's clearly a positioning in terms of institutional money that they want to be in a safe haven asset. And so we're seeing big demand stories for the US. And what that does for the global economy is actually not that good. And the reason why it's not that good is because a lot of emerging markets, they take on their debt in US dollars. So if you're Bangladesh or Pakistan or some of those countries, you end up having to pay your debt off at a much higher rate. And so it starts to put financial stress in the global economy or the global financial system. Now, you could look at this both ways and go in terms of commodities at least, and go, well, it's certainly a dampening situation right now for commodities. And historically, they're negatively correlated with the US dollar. They're all priced in US dollars, and that's why the price of it goes up. It costs you more if you're China or whoever. But the flip side to this is, well, at some point this will mean revert. The US dollar isn't going to stay at this level forever, and when it does, our expectations will be really, really quite good for commodities. That actually means it'll be quite good for the Australian economy as well, because we'll see a lot of financial inflows and demand, because we do have some just absolutely fantastic mining assets and miners. And you can, I know we didn't do an overlay here, but you'll notice that peak to the left-hand graph was 03 and then went right the way down to 07. That was a fantastic time if you were involved in anything mining in Australia. And there's other reasons, don't get me wrong, but it does provide some level of support for us as to why, and we'll touch on asset allocation later, why we're a little bit more bullish on Australian equities compared to global.
Yeah. And just on that, our commodity price demand obviously has a big influence on that, and economies such as China.
Yeah, so we've got a dedicated page to China through here, but you're right. China has a few issues at present, but one that I think does sort of fit into this page at least is the devaluation of the yuan. So at multi-year lows. The last time we saw this was that 2015-2016 period, which was not a good time for commodities, China being one of the largest consumers. And so it is definitely having an impact in terms of China as well. I know these two graphs, I won't spend too much time on, but I do think they are important because when we think around what's happening in the world, global monetary policy is really at the core at present, and it's called quantitative tightening. Quantitative tightening has only really ever occurred once before, and it was a disaster. Equity markets and global bond markets fell, and it caused the Federal Reserve to do an about face. Now this is something that we're going to have to go through because inflation this time around is so high, and so the US is starting to really ramp up its tightening. You can see to that right hand side that when global monetary policy is tightening, what it's doing is it's pulling that US leading indicator down. It's a leading.
So maybe a little bit of context around global monetary policy tightening.
Yeah, certainly. So over the past 2 years, we'll take it here, it was called quantitative easing. And what that means is central banks were pushing money into the economy.
Yep.
And then, that's the first order effect, right? So you've got ample liquidity and banks will go, well, I can loan you at a fixed rate loan at 2%, whatever it was in Australia.
And the benefit of that is, as a business, you would then go
business or consumer. And that's the second order effect. I'm spending, my wealth effect's going up because I'm buying more assets. Really positive. Well, the opposite is true when you're tightening.
Yep.
Cash is being taken out of the financial systems. And so that's the first order effect. It's then what does the consumer do? What does the corporate do? And that's the really tricky part because there's no historical context or pretext to this situation. And so that side there, we think that even as we move through this and let's say quantitative tightening happens and then they immediately stop, you can see that those leading indicators are still going to start to drop off. And the other one, which is, it sounds more confusing than what it is, the diffusion index to the bottom. The reason why we've put this in here is because it's actually showing that 100% of the OECD countries' indexes are actually down. And there's only two other times in history that that's occurred, GFC and in the 1970s. So both aren't pointing a pretty picture. So a little bit about the situation in Europe. I know it's dominating headlines, so we wanted to put this in. The oil and LNG prices in Europe right now are at historical highs, and I think everyone knows the reason. But the war that Russia has waged against Ukraine, and then they're starting to weaponize gas flows into Europe through they're shutting down their Nord Stream pipelines. It is creating an energy crisis, and so what that means, we're going to see sky high inflation over in Europe. There's research houses out there that are talking around 18% inflation for the UK coming in post Christmas. And so it is a very real possibility that may see blackouts. I think rationing is going to happen.
A cold winter coming up.
Winter is coming. So it is worrying. We are negative. in terms of Europe and UK in terms of our asset allocation. I'll touch on that a little later. So this is just finally on China. You can see that the PMIs in China are starting to deteriorate. We've got the GDP for quarter.
So PMI?
Purchasing Managers Index.
Yep, and that's important because?
Basically, it's important because it gives us a gauge of where managers of industrial and output type companies are expecting their orders. And so just to give you a little bit of a background, above 50 means it's not contracting. What's the other word for contracting? Expanding. Expanding. Thank you, brain fog. And beneath means it's contracting.
Yeah.
Now, it's clearly on a downward trend, and then we couple that with what's happening in their property sector, which is a very difficult situation. That's a very big proportion of their GDP. They're continuing to do these rolling lockdowns over there, and it is causing supply shortages. So we think that China is a little bit of a risk. We do have Xi Jinping getting re-elected, and there may be some policy responses post that. But the expectation, at least, is that with this deterioration, there needs to be some accommodative stimulus to go through their economy, and that will be, or at least historically has been, very beneficial for the Australian economy.
Right, the important part.
So investment
Something
strategy. Yeah. And well, what we thought we'd do is just show you how difficult a year it has been.
Yep.
And so we've taken this from BlackRock, BlackRock being one of the world's, or if not the world's largest asset manager, just to show you how tough it has been for both defensive and global equities throughout 2022. And so that little red dot there can show you that it is really almost a once in 20 odd year event. So we've got negative returns on defensive assets, we've got negative returns on global assets, and that's to FY 22. Now to the right hand side, this is all about the investor. This is about how much risk you're going to take and how your returns have been. And so if you're a conservative investor, what you would typically see is very, very low volatility, a lot lower return hurdles. That has not been the case for this year. And you can actually see that if you took an aggregate over 3 years, if you're a defensive investor, because of the carnage that's happened in fixed rate bonds, you're sitting on a negative return.
And what's not necessarily pictured there is couple that with high inflation.
Correct.
Your real return is a lot worse than what it shows.
And so, people tend to think, well, the risky assets have been the really difficult part. Yes, they have been difficult, but we actually think that the defensive asset class for the last year has been the most difficult period that we've had to deal with. And we don't think it's over. We think that these interest rates and volatility in traditional asset classes, so fixed rate bonds, has a little bit further to go. And what we've tried to do is have a look at, well, where is value within the fixed interest space, because we do think that there are some real opportunities there. And then on top of that, we have to be cognizant of credit spreads, because and we'll touch on this on the next couple of slides, but when we think around risk premiums and how much extra a consumer or an investor is required to take on equity type return or property type returns, it does flow through into that defensive space as well. So this is the fixed interest, and something that I think is really important, and how we've been positioning really for the last couple of years is in terms of floating rate notes compared to fixed rate notes. And so all this really means is if you have a bond, it can pay you out two ways. One, you can have a set amount and it will pay you that out for the period that bond is available for investors, so its maturity date. And so let's say that's 3%, which was a typical 10-year government bond yield. Now, as interest rates move up and inflation expectations move up, you have to recalibrate the bond you as the investor have to do this in order to adequately get your acceptable return in the current environment. So you can't change the yield that the bond pays you. So how do you do it? You sell it off. So it's the capital value.
You pay less for it.
Yeah. And so the capital value of that bond is the recalibration. And so this year we have seen really big volatility in traditional asset classes. And that's the reason why those conservative investors have had such a really tough time.
Yep.
The other way that you can get your fixed interest exposure is called floating rate notes. And so that means that you get a fixed margin, but it floats above a benchmark. And there's plenty of different benchmarks, but the one that we focus on in Australia is the 90-day bank bill swap rate. And so that graph below, where there's what we've done is we've set a common base over the past 2 years. We've just taken a simple ETF that tracks Australian government bonds, and that's the pink line. And then what we've taken is a floating rate hybrid ETF, and all they hold is floating rate notes. And you'll notice that the volatility within the floating rate notes is a lot less. So why is that? It's because the recalibration is happening through its distribution.
The capital value. Oh, no. for the floating rate.
Correct.
So it's happening with the credit spread above your 90-day bank bill swap rate.
Correct. Yep. And so we've seen less capital deterioration over that 2 years. You can see it starts at basically 100 and it goes up to 101 and I think ends at about 99 there. Whereas the government bond index over that same period of time is down 18%. We will also point out that this doesn't include income. So the income off those lower volatility floating rate notes has actually been increasing as well, whereas you're still getting paid that same fixed percentage, but if you're buying that bond now, you're getting a higher percentage. So what we're trying to say is floating rate at present has been an excellent place to be, and we continue to think that.
Yeah, so if we look at the outlook where we've got rising interest rates, the expectation is we're going to have rising bank bill swap rates. So if we get in these fixed margins above that, we've got a growing income stream, which is difficult in this particular environment. One of the other things just to make note on these too is that the liquidity of these are on the Australian Stock Exchange.
They are,
which creates a great option. So we always focus on flexibility and liquidity events. And secondly, they can have a tenure between 5 and 7 year call date. So one of the approaches that we take with these is actually we stage out the maturity profiles of these so that we create an additional opportunity. So when we do have a liquidity event, we know that across a portfolio, they will move back to their $100 or face value for maturity. That's right. So that's another risk management, particularly in this space.
Yeah. So I know it can feel a little bit overwhelming with all the economic data going on. So we thought what we'd try and do is condense this down and go, well, with the global economy the way it is, what are we expecting for equities and fixed interest? And so right now, we think a lot of the deterioration that's occurred in global markets has all been to do with that risk-free rate moving up. That's the cost of capital for businesses. Yep. It's going up. And so you're feeding this into a discount rate, for your valuations, and you're coming up with a lower number. So you've seen a decrease that way. What we haven't seen is an earnings downgrade cycle yet. So that hasn't occurred. And we think with the way that this economy is starting to turn, that there is a real possibility that this may happen. And on top of that, what also hasn't happened is how much you or I or any other investor is prepared or requiring to take on equity risk or return risk. And so that comes back down to that earnings risk premium. In quantitative easing, down the bottom, which is in green, you can see the earnings risk premiums fall. They go right down because you're not required to take any real excess risk to take on that growth outlook. In quantitative tightening though, and the one time that we've really seen it is in the pink there, you can see that it does go up, and it goes up at a fairly rapid rate. And we haven't seen this in terms of equities yet. So we think that there's very likely to be an increase in the risk premium that investors are required to take on. And we're also looking at historical context and going, well, if there are this earnings downgrade cycle potentially coming, well, how does different sectors respond to this? And I don't think it's rocket science, but I found this really interesting from State Street Global Advisors, where you're looking at, well, this is some really, really bad corrections to the bottom right of the screen that have occurred over the past 20, 30 years. How do traditional defensive sectors respond to this compared to just the market? And you can see it's a very, very big difference. And so that's sort of our thought line. We think that, well, if risk premiums are going up and we may have an earnings downgrade cycle about to start occurring, what's going to be the main point of your total return? And we think dividends are going to be really, really important over these next 12 months. We want to make sure that they're stable as best you can, and that they're able to, or again, as best they can, able to pass on any sort of input cost pressures onto the end consumer looking for non-discretionary expenditure.
Yep. So one of the things that we focus on there, which the sustainable competitive advantage or moat, is important to be able to control some of those attributes that you're talking about, passing on input costs. The other thing to be mindful of too is that if you're looking at a portfolio, and what Kenneth was referring to, there's dividends going to be a very important component of that, or some may say, we're looking at a dividend return profile for the market in the coming period, is actually just because it has a high dividend yield, it doesn't mean it's going to be a sustainable dividend yield.
That's right.
So a focus on quality is of the utmost importance at this point in time.
Agreed. Just again, I think that might have been a double up. Oh, apologies. Just on to maybe some sector exposures. We're underweight global equities as an asset class. We still like Australian equities. We think those dividend profiles, lower valuations compared to other indexes around the world, still makes us look attractive. And we do have that old world type economy, mature companies, which at present are making fantastic money. And so we're just taking a slightly less optimistic approach, and so move that down a little bit. And then where we have seen, or where we are moving to, is an increase of cash. That's really the bigger move out of what we were positioning in Q2 to Q3. The simple reason for that is we think that there's going to be volatility ahead, and we'd like to have some opportunities to present themselves. So just on, we always do this. I think it's important to keep ourselves honest. This is the exact slide of what we put up in April 22. And we were talking about this before we came on.
Yep.
What we think we want is not to see huge changes. And I actually think that when we look through this, we want larger companies with stronger balance sheets. We really like defensive type companies, so we tend to focus on healthcare. We were looking at gold and still have positions in gold as well. And what we were doing was trimming back some of the extended energy stocks. So for those of you that may not follow the markets as closely as we do, lithium and coal have continued on. So you could argue that we possibly we got it wrong, but I'll take the other side and say you always want to take profits in cyclicals because they are cyclical. You will get another chance in these. And then I suppose lastly, the only one that I would want to target there is that potential for BBSW, so bank bill swap rate, with interest rates lifting. And so that for us has really helped our defensive clients. So what are we looking at now? Again, we if you haven't got this, we're sort of taking a defensive stance for the next 6 months. And how are we doing that? Well, we want to take on some consumer staples. We still like Endeavour. We still like the healthcare. And it's not to say that, when you think around companies and the word technology, people tend to think that high volatility, not strong balance sheets. Well, we think Microsoft and Google are strong, and we've been utilising this sell-off to continue to add to those exposures. Still focused on inflation linked revenue as inflation goes up. So that's in a fixed interest space, but also in infrastructure. So stocks like Transurban come to mind. And then we are equal weight banks, but recent ads were NAB and continue to hold some Medibank Private. Things that we're looking for, weakness again in China and the global economy. And on top of that, we are negative on Europe and the UK. But coming into that calendar year 23, and let's say the dollar, pound, and the euro are exceptionally weak, and they are at present. What you might see is a potential unwind of that. You might get a free cost of carry, and there's some great companies over there, particularly focused on some of those staples and non-discretionary spend. The area that we have, it's a new area that we think is starting to look attractive, and we think that private equity will have the ability to start picking up some pretty good businesses if interest rates do bite corporates. And so it does look quite interesting to us. Unlisted infrastructure as well, that's going back to the inflation-linked revenue. Also looks interesting, but what we are concerned with is opaqueness. We won't be able to see as well as you can see on the Australian stock market, at least, the debt levels of some of these companies and what's happening behind the scenes.
Yep.
So lastly, just a little bit about our Australian equity models. We use consensus research data, and you probably see that we do drag a lot of sources from different research houses here. But just to the left is just our performance 1, 3, 5, and since inception for our older models. So balanced income and growth. I suppose what I would point to is the huge outperformance in income compared to what we've traditionally seen, at least over the past decade, compared to the balance and the growth. And the reason why is that's going back to that old world economy. People are much more focused on dividends and profits right now, and it's shown up in this 1 year return.
Yeah. I think the important part there is that they do carry different attributes and different objectives. So, why wouldn't we carry some of those to the growth? And that's because of what our mandate is within those models. So we just stay true to our mandate on that.
True to label. Exactly. And so on the right hand side, we do have an ethical model portfolio. It hasn't been running for as long. What has affected it over the past year, because it has had a negative return, zero energy exposure. So when you think around coal, and you think around Woodsides and Santos's and all having fantastic years, well, everyone's different, but our negative screens those out. But pleasingly, over the 2 year and since inception, we really like the annualised performance there.
Lovely. Probably just a quick comment also with those there, that they are Australian equity models. So that represents our Australian equity asset allocation. So whilst we are actively managing that space and we do take some cash, the comments on some slides earlier from Kenneth, where we do like cash positions, is that we do that through our asset allocation process, even though that we do carry some in these actively managed models. So on top of that, it sounded a little bit gloomy, but I think it's just realistic around how you actively position your portfolios, not so much gloomy.
I completely agree. I think there's plenty of opportunities out there,
yep.
And ones that we touched on. So making sure that you're getting those dividends, you're potentially looking at floating rate notes, just tinkering around. So strategic asset allocation.
Yep. And I guess to that extent, around the strategic asset allocation and actively manage, if those investors that are coming into the market now, particularly retirees, you need to be alert and aware of it, not so much alarmed. I mean, there are mechanisms that we do operate to manage that risk, such as sequencing risk. The way that we actively manage the asset allocations, taken into some of that cash and defensive positions. So feel free to reach out if you're in that position and have concerns. All right, to that extent, thank you very much, Kenneth.
Pleasure.
Any closing comments?
No, I think we covered it all. I hope everyone's staying safe and well, and look forward to the next one.
Great. Appreciate you joining us. And as always, if you do have any concerns or you'd like additional information, please don't hesitate to reach out. Thank you.